You hear about the stock market on the news literally every single night. You see the red and green numbers flashing across the bottom of the screen, but beneath all that incredibly complex financial jargon, how does it all actually work? Well, today we're stripping the whole thing down to first principles. In this explainer, we're going to look past the complicated charts and totally decode the foundational mechanics of the market. So, what exactly is the stock market? Let's start from the absolute ground up here. At its core, it's really just a marketplace. But instead of buying groceries or, physical goods, it's a marketplace where people go to buy and sell ownership in actual businesses. Basically, it connects the folks who have capital with the businesses that need it. Which naturally leads us to ask, why do people invest in it? Why not just leave your cash safely tucked away in a standard savings account? Well, it's because people want their money to actively work for them. They're looking to capture a piece of the financial growth generated by the world's most innovative companies, rather than just letting inflation slowly, quietly eat away at their purchasing power over time. Okay, so why we do it makes sense, but how does it actually work? Let's kind of pop the hood here and define the most fundamental building block of this massive global system. That building block is a stock, or a share, and it's exactly what it sounds like, a small piece of ownership in a business. You have to remember, you aren't just trading abstract numbers on a screen. You are buying a legal piece of a real-world entity. This idea actually dates all the way back to the early 1600s. The Dutch East India Company became the first business to issue shares to the public to fund these massive global voyages. And when you buy a share today, the underlying principle is exactly the same. If that company expands, you, as a partial owner, get to go right along for the ride. But let's flip the perspective for a second. Why do companies need money so badly that they'd sell off pieces of themselves? Well, running a thriving business is incredibly expensive. Whether they want to launch new products, hire more employees, expand to new markets, or build new factories, companies just need vast amounts of capital to make it happen. So instead of taking on crushing debt from a bank, some companies choose a different route. They go through a process called going public. Going public is simply the process where a company sells ownership to the public to raise capital. It completely opens the doors to everyday investors like you and me. It's a win-win, really. You get a piece of the pie, and the company gets the massive cash injection it needs for its next big expansion. All right, so the company is funded. But for you, the everyday investor, why do people buy stocks? The goal is simple, to grow your wealth. And when you back a strong, well-managed company, there are two main ways you actually turn a profit. The very first way is through stock price growth. Let's say you do your homework and buy a single share of a promising tech company for $50. That $50 is your baseline investment. Now, let's say over time, the company just executes flawlessly. They drop a hit product, sales go through the roof, and profits soar. Because the actual underlying business is objectively more valuable now, the piece you own is worth more too. Let's say it jumps to $80. Your initial investment grew simply because the business succeeded in the real world. The second way you make money is through something called a dividend. A dividend is a payment from a company sharing a part of its profits directly with investors. Now, not every company does this, but many established ones will share a cut of their cash with you, usually every single quarter. It's basically a recurring thank you payment for being an owner. You're getting paid cold, hard cash just for holding on to the stock. Which brings us to the thing that causes, honestly, the most confusion for beginners. If we know how long-term value is created, why do stock prices move so much? Why are they constantly fluctuating up and down, minute by minute, every single day? Honestly, it all comes down to supply and demand. It is the absolute simplest economic concept out there, yet it dictates the entire global market. Think of it like real estate in a super trendy neighborhood. If demand is high and everyone wants a specific stock, the price surges. But if everyone suddenly panics and rushes for the exit to sell, the price plummets. So what actually affects that demand? It's a pretty volatile mix of hard data and human psychology. Things like company profits, economic news, interest rates, and industry trends can fundamentally move the needle. But, and this is crucial, prices often swing wildly just because of investor emotions. Fear or excitement over a sudden news headline. That constant collision of hard facts and reactive feelings is exactly what makes the short-term market so unpredictable. And if you're wondering who's driving all this movement, well, there are all types of participants. It's a massive ecosystem. You have individual investors trading right alongside professional fund managers, giant institutions, global banks, and massive retirement funds. We're talking about billions of shares trading hands daily. And because they're all buying and selling for completely different reasons, some want a quick flip, others are holding for retirement, it creates that chaotic daily movement you see on the news. And because of all that short-term chaos, it is incredibly easy to mistake the stock market for a giant casino. Look, if you're just buying random stocks without understanding them, gambling is exactly what you're doing. But real investing is the exact opposite of gambling. Real investing means understanding the businesses you own, actively managing your risk, thinking long-term, and staying relentlessly disciplined. Make no mistake, there is real risk involved here. Markets will correct, economies will dip, and prices will drop. That's just a fact. But if you panic every time the chart turns red, you're gonna lose. Successful investors focus on blocking out that emotional noise. They rely heavily on patience, diversification, which just means not putting all your eggs in one basket, and long-term thinking. So, if you're ready to dive in, the roadmap is actually really unintimidating. Step 1, learn how businesses and markets work, which, hey, you're already doing with this explainer. Step 2, start small with consistency. You literally don't need a fortune to begin. And step 3, just grow your confidence over time as you get a feel for the market's rhythms. Ultimately, the market is an incredible mechanism for investors and businesses to build wealth together. But surviving it? That means ignoring the flashy hype and those totally empty promises of overnight riches. Real success comes from 4 sturdy pillars: knowledge, patience, discipline, and long-term thinking. The stock market is not just about money. It's about ownership, growth, and building your future. Once you really grasp these basic mechanics we talked about today, the market stops being a confusing casino and becomes a seriously powerful tool. So the only question left for you is, what piece of the future are you going to own today?